The rise and fall of Enron is one of the most shocking corporate scandals in history, a story of deception, greed, and financial manipulation that wiped billions of dollars and destroyed thousands of lives. Once considered one of the most innovative and successful companies in America, Enron collapsed almost overnight, exposing a web of fraud that had been carefully hidden for years. But how did one of the biggest energy companies in the world manage to fool regulators, investors, and even its own employees? And what can we learn from the scandal that shook Wall Street to its core? Enron began as a relatively modest energy company, but rapidly expanded into a Wall Street darling, thanks to its aggressive business model and supposed commitment to innovation. It claimed to have revolutionized the energy industry by pioneering the concept of trading energy like a financial asset, allowing companies to buy and sell electricity and natural gas in much the same way stocks and commodities are traded. This led to enormous profits, on paper at least. Enron executives boasted about the company's future, and its stock price skyrocketed, making it one of the most valuable corporations in the world. But behind the scenes, something far more sinister was happening. At the heart of the Enron scandal was a practice known as mark-to-market accounting, a highly controversial method that allowed the company to count potential future profits as current revenue. This meant that if Enron signed a multi-million-dollar deal that wouldn't generate profits for years, they could record those earnings immediately, inflating their financial statements. In reality, many of these deals never became profitable, but Enron continued to hide its losses through a complex network of off-the-books partnerships. These secret entities, known as special purpose vehicles, SPVs, were used to move debt off Enron's balance sheet, making the company appear far more successful than it actually was. For years, investors and analysts believed in the illusion. Enron's stock soared, and executives reaped enormous bonuses based on the company's performance. But beneath the surface, cracks began to form. In 2001, financial analysts and journalists started questioning Enron's accounting practices, and when the company was unable to provide clear answers, confidence began to crumble. The real turning point came when Enron's chief financial officer, Andrew Fastow, was exposed as the mastermind behind the company's financial manipulations. Fastow had personally profited from the fraudulent schemes, setting up SPVs that allowed him and other executives to siphon money while keeping Enron's debt hidden. As investors panicked, Enron's stock price plummeted from over $90 per share to less than $1, wiping out $74 billion in shareholder value. Employees who had invested their life savings into Enron's retirement plans lost everything. Meanwhile, top executives, including CEO Jeffrey Skilling and Chairman Kenneth Lay, had cashed out before the collapse, walking away with millions while their employees faced financial ruin. The scandal triggered a massive investigation, leading to one of the largest corporate bankruptcies in U.S. history. The fallout was devastating. Thousands of employees were left without jobs, pensions, or severance pay. Arthur Andersen, one of the world's largest accounting firms, was found guilty of obstruction of justice for shredding Enron-related documents, leading to the firm's eventual dissolution. The public outcry was so intense that it led to the creation of the Sarbanes-Oxley Act, a set of strict financial regulations designed to prevent corporate fraud and hold executives accountable for financial misrepresentation. In the end, Enron's top executives faced justice, at least to some degree. Jeffrey Skilling was sentenced to 24 years in prison, though he was later released early. Andrew Fastow served 6 years for his role in the fraud, and Kenneth Lay, Enron's founder, died before he could be sentenced. But for many, the damage was irreversible. Investors lost their life savings, employees were left with nothing, and public trust in corporate America was severely shaken. The Enron scandal remains one of the most infamous cases of corporate fraud in history, a cautionary tale about unchecked greed and the dangers of financial manipulation. It serves as a reminder that when corporations prioritize profits over ethics, the consequences can be devastating, not just for the company, but for everyone connected to it. Even today, the lessons of Enron continue to shape financial regulations and corporate governance, ensuring that such a scandal never happens again. Or at least that's what we'd like to believe. Because if there's one thing history has taught us, It's that greed never truly disappears. It just finds new ways to hide.